Hello and welcome to today's live technical analysis. Starting off with the euro. So, currently, we're expecting the release of the preliminary HICP rates for the eurozone. I think, if I'm not mistaken, they've been released. 30-minute chart, we're seeing a slight weakening. So, I'd say either they came in as expected or just below, since we're not seeing a material impact on the euro, but the slight weakening of the common currency could imply that the preliminary HICP rates came in lower than expected, which may be allowing the US dollar to gain. In terms of Fed speak yesterday, we're noting slight hawkish sentiment emerging. Now, despite Fed policy master also stating that three rate cuts is a possible scenario, yet that is a very thin line. I would personally take that as slightly hawkish, despite the market reacting negatively to those comments. I would anticipate that it is a bit hawkish based on the fact that it is the dot plot for three rate cuts. So anything implying that that might not be the case could be perceived as hawkish, as such providing support for the US dollar. Overall, from a technical point of view, as we had stated yesterday, our downwards moving trend line appears to be continuing, so being validated again, again, again. Note the pair came up to the mid range of the Bollinger Bands, rested, but is now moving lower in coordination with the downwards moving trend line. RSI at 45 implies slightly neutral market sentiment, but with some bearish tendencies. Now, this could be a market correction before continuing on its descent. I would place emphasis on Fed Chair Powell's comments later on today, in addition to the ISM non manufacturing PMI figure, which is due to be released. Overall, I would be bearish for the particular pair. And for our bearish outlook to continue, it would have to break below S1. If it fails to do so, we could maintain a sideways bias between S1 and R1. And currently, I do not see the case for a bullish outlook for the euro. However, in the event that we are wrong, for a bullish outlook, we would require a clear break above R1, next potential target being R2. Dollar JPY. So, moving in a relatively sideways fashion. From a fundamental point of view, the Japanese yen might be weakening due to the earthquake of 7.2 on the Richter scale that occurred earlier on today near Taiwan. And with the potential of a tsunami, so there are warnings about potential tsunami in the region, you might see the Japanese yen weakening, which is why the dollar may be slightly gaining. But from a technical point of view, 62 RSI, bullish tendencies, but we would have to see a clear break above R1. Next potential target for the bulls being R2. On the other hand, sideways bias between S1 and R1. You can see the support and resistance levels. You can chart them yourselves. Relatively sideways, narrowing of the bullish band, so low market volatility. This could be only temporary. Bearish outlook to continue would require a clear break below S1. Dollar CAD, I would not be surprised to see the loonie slightly gaining. Now, I would attribute this not to the loonie weakening, but to the dollar strengthening more than the loonie. Still moving in a relatively sideways fashion between S1 and R1. And why would I say that this is not the loonie weakening? As we said yesterday, oil. So the potential risk of a retaliation by Iran is moving oil prices higher. Continues to validate our upwards moving trend line, RSI at 70. Removing the CCI because it's not moving in a predominantly sideways fashion. We could add the on balance volume, so we're seeing where it's moving. If the OBV is moving in an upwards direction, in addition to the commodity, then it could validate our bullish outlook as well. So that's OBV. So trend appears to be in an upwards fashion. You have RSI at 69. You have the upwards moving trend line. So all indicators point towards a bullish outlook for the particular commodity. For it to continue, however, validate the upwards moving trend line, so a continuation, and breaking above 85.40. Next potential target for the bulls being 87.90 should it break above R1. On the flip side, a break below the upwards moving trend line could constitute a switch towards a sideways moving bias, so staying between S1 and R1. However, in the off chance that it does break below S1, we would switch for a bearish outlook. In terms of fundamentals, we know that OPEC plus, the ministerial group, is set to meet today. According to sources cited by Reuters, they're not expecting a change in the oil production cuts, which could provide some support for oil prices. Now we have two financial releases. The API yesterday implied a greater drawdown than what was expected, so supporting the theory that demand for oil may be increasing. Should the EIA weekly crude oil inventories figure also validate this drawdown, so implying an increase in demand, we could see oil prices moving higher. However, should it come in higher than expected, so implying either an increase in inventories or a lower drawdown than what is being expected, it could weigh on oil prices. But personally, from a technical and from fundamental point of view, I would maintain a bullish outlook for oil. Moving on to the Aussie, if I'm not mistaken, let's see on the day, bearish. China's Caixin Services PMI figure came in as expected. It still implies an expansion in activity, but we're seeing the dollar strengthen. So even though the indicators appear to be good for China, the dollar strengthening appears to be mitigating the potential benefits to the Aussie from financial releases stemming from China. As such, we would maintain a sideways bias as there appears to be a tug of war between the Aussie and the US dollar. Sideways between S1 and R1, mid range of the Bollinger Bands, RSI at 50, so a neutral market sentiment appearing to emerge for the particular pair. Onto the British Pound. Now it's testing R1, 1.2575. It's actually testing it now. This could be a slight recovery for the particular pair. Now, it's a bit odd that the British Pound is strengthening against the US dollar. So it strengthened yesterday. That's a bit interesting. It's actually just above our resistance level, 1.2575. Now that's a bit interesting. So we could bring our support level, but that would be too close to the current price action. Now, is this resistance turned to support, or is this simply an intermediate level? So we have the RSI 44. Let's look at the volume as well. Let's add a few other indicators. Picking up. Let's see what else can we use. Chimoko, parabolic SAR. Let's just make this a bit easier for you to see. There we go. I would still maintain a bearish outlook based on the parabolic. RSI going near 50 could imply that this is market correction, so I'd bring my resistance level slightly higher. 1.2590 for R1. 1.2590. Let's keep S1 at the level we brought up to, so 1.2535 for S1. Now, this could be a correction to the mid-range before continuing on its descent. We need to remove the volume indicator for our other labels. S1, 1.2535. So we're just bringing S1 higher to reflect the current price action. So it came down to S1, bounced off. So this is a support level. But that means we need to readjust our other support levels as well. So bring them slightly higher because it's simply put too far away. But then we don't want it to be too close to S1. So if it does break below, then so it does break below. S2 is not too close. I'll walk you through my theory for placing S2 here. Right? Let's just move this. So S1 we've placed at 1.2535. S2 can't be here. It's too close. Like look at the 4 hour candle. It could just break below, and then you would aim for S3 immediately. So this might not even be a significant support level. It could, but if you look at the price action, this is where it found support. It bounced off, correcting, could move lower or could move sideways if it narrows extremely, like the dollar against the Japanese yen. But the price action shows that this is support. So where's S2? If I place S2 here, let's just, for argument's sake, let's just see. Let's place S2. That could be S2. That's far too close. So if it does break below S1, S2 is just immediately there. So it might not actually meet significant support. So I'm choosing to ignore this level. I'll go back and see. Now, I could place it here, and that's one. That's one possibility. Another is here, and I'm looking at this level in particular because of this price action here. Oh, wait, no. Sorry, excuse me. This price action here. So it's coinciding with the opening and closing of these candles. Note how it came back up, found, pierced through, took out everyone that was potentially had a stop loss here, moved higher. And it's also coinciding with an old higher high. This, however, you have 2 wicks that came back down, perhaps to gain some liquidity before moving higher. So they're fairly close to each other, but for a trader, this could be all the difference in terms of support. So let's just see. Let's add some volume as well. Let's look at how it was here. Higher volume. So I'm seeing more volume on the wicks. So I'll take the 2 wicks as my S2. It's a bit too far away. So I don't really like having my S2 that far away. It's a significant distance. Let's look at R1 and R2. So even though this actually might be a significant support level, if you look at the bigger picture, it might be better if we adjust our support slightly higher at this intermediate high, broke above, so it came, found resistance, broke above, so this could be a valid support level as well. Let's look at the volume, higher volume than the wick, higher. So I looked for this level as my S2, and then for S3, note the price action here. Look at how many times it tried to pierce through, failed to, came back down. The bullish candle closed on the resistance and opened, so broken above, pierced through, took everyone that had a stop loss perhaps here, and then moved higher. So got some liquidity and continued on its ascent. So we are readjusting our support and resistance levels. 1.2305, that's for S3. For S2, I'll take 1.2435, so we're just rounding it up. Excuse me. 1.2435 for S2, and then for S3, 1.2305. So let's take R1, R2, R3. Now, R1 would be an intermediate level. As we've said, we've simply just readjusted R1, right, slightly higher. If it does break above R1, I'd switch for a bullish outlook if it moves towards R2. If it fails to break above R1, we could maintain a slight bearish outlook. But for a sideways bias, I'd like to see it break above R1, fail to break above R2, and then come back down to resistance, turn to support, and staying between this channel. I wouldn't maintain a sideways bias between S1 and R1 as they are far too close to one another. And then 1.202305. Let's look at gold. Still bullish on gold. You have geopolitical tensions. You have continued risks. So you have an earthquake. That's an unexpected event as well. So no one can really predict when and where. When stability is rising, then you have, I'd say, I wouldn't say political. It's more of a geopolitical tension. So this could be a correction. I wouldn't be surprised if gold actually comes back down here. Actually, here comes back down here, doesn't break this higher low, validates the upward swing trend line, and then continues on its ascent to 2.3k. For now, we're keeping our support levels, and we could actually just bring S1 slightly higher, 2,238, and we can keep S2 the same. S1, S2, S3, and then S4. Now, if you'd like, if you're more of a short term, so if you're more of a day trader, you could place, but we are using the 4 hour time frame. But nonetheless, if you're more of a short term period guy, you could look, or person, individual, 2,175, which is actually a nicer support level than 2,147. So we'll change that. I'll keep S3 the same. I'll keep S3 the same. It's equidistant. You can see spaced out more or less evenly. So we're giving it some room to breathe. Breaks down below S1. Then you have S2. Lower than that, S3. So we can use this for a more macro perspective as well. On the daily, I'd say that this is more of a retracement. Like, it's above the upper range of the Bollinger Band, so it might be Joe market correction lower. Now, if you look at the RSI as well, it's at 78. So it implies that the precious metal might be overbought and due a market correction to lower ground, which is on the daily. If you look at the 4 hour, however, tilted to the upside, correction to the mid range before continuing on its ascent. Now we'll look at Tesla. Tesla, if I'm not mistaken, dropped by 6% yesterday, so they missed their orders. That's pretty bad for the company. In terms of support and resistance, we don't really actually have to do anything. We could, actually, let's see. Could we? Yes, we could. We could simply readjust R1 slightly higher, reflecting this price action. 174.75 could still be valid, but the recent price action, let's just give it a bit more room just in case it moves higher in the pre-market. So let's readjust our resistance level at 181.35. Yes, price action. This is a bit odd, but still 1, 2, 3. Pierce through, it doesn't matter. 5. You're seeing a resistance level around this point, taking the most recent price action. So that's not too bad. It's below, so it could correct to the mid-range. RSI at 38, so implies bearish tendencies in the market. Overall, could be bearish for Tesla, but it would have to break 152.65 is too far away. Let's readjust our support and resistance levels first. So S1, recent price action, 161.50. Then let's go back and see. That was a stock split, so we don't really have historical data. So what do we do in this case? 2651, measure the distance between R1 and R2. We will do gold again, yes. 137.25. Since you have asked, we'll go back to gold in just a moment. Just give me a second to finish with with Tesla. And then we could keep 102.75. just in case it does break below S2. Overall, bearish outlook, missed on deliveries. That's bad for the company stock price unless they announce something new. Then I would still be bearish because you have BYD in China competing with Tesla. They actually even raised the price of the Model Y, so it could lead to lower sales, and as such could allow BYD to gain a greater market share of China's EV market, which is bad for Tesla. Going back to gold. So gold, you can look at it from a technical point of view or from a fundamental. From a technical point of view, open up your 4-hour chart, and then you'll be seeing what I'm seeing here. You have higher lows and higher highs. Some of you may be concerned with this bearish candle, but if you look at the other side, it's still at 66. Then you have an upwards moving trend line that was validated on 3 to 4 occasions here. The Bollinger Bands appear to be tilted to the upside. So it does imply there is a bullish sentiment for the precious metal. This is purely from a technical standpoint. Ignoring the fundamentals, from a technical point of view, you have higher highs, higher lows, and you have an indicator validating that, supporting, not validating that hypothesis. On the daily, now you could say this might be overbought since it's above the upper Bollinger Band. So it also implies that it might be due a small correction lower. So it all points to higher, but correction lower, above 70, so slightly overbought. But if you drop down to the 4-hour, which is what we prefer to use, it looks that it's moving in an upwards fashion. Now, if you combine the fundamentals for gold, and when we say the fundamentals, you can simply Google strike against the Iranian consulate. That's a problem. That's a geopolitical risk. Because, if I'm not mistaken, Iran's ambassador to Syria stated that Iran will respond at the appropriate time and place. Now, tensions in the Middle East are already very high. This could increase them even more. So, in times of uncertainty and geopolitical risk, for example, you could take Venezuela and Guyana, where Venezuela had a referendum over territorial integrity belonging to Guyana. That increases tensions. There was a risk of a military escalation. That could funnel inflows into gold. Despite the dollar strengthening overall, you're seeing gold strengthen as well due to those risks, in my opinion. Therefore, with the risk of Iran potentially retaliating against a strike on its consulate, that could funnel inflows into gold because tensions are high. Then, if you have tit for tat responses, that's very bad in terms of geopolitics, and then tensions, and you could see safe haven inflows into gold. So, if you combine the fundamentals and the technicals, I would be bullish for gold because technical trend line, Bollinger Bands are high, higher highs, higher lows. Fundamentals, you have elevated geopolitical risk. Now, if nothing does happen, so let's say a month passes and nothing does happen, that risk could dissipate, which could weigh on gold's price. On the other hand, one could also say that the NFP figure on Friday could strengthen if it shows a resilient labor market. It could strengthen the dollar so much that it could actually weigh on gold. But that's on Friday. For today, we're looking at the geopolitical risk and the technicals. The technicals for now imply that this may have been slightly overbought and is due market correction lower before continuing on its ascent. Should it validate the upwards moving trend line and should it break above, let's just bring this slightly lower, 2,285. Let's just reflect the price action. So there, if it comes lower, but if it breaks above, you could still maintain a bullish outlook. Now, we've said about a bullish outlook. What about a sideways bias? Sideways bias. So, if someone had gone potentially short at R1, then took profits at S1, then went long, so playing in between this range, I'd like to see RSI at 50. I'd like to see a break below the trend line, but not a break below S1. Because if it breaks below S1, then you can see the predominant trend might be changing. the intermediate trend, if you like to say it that way. You could have a lower low, and then let's say it breaks below, comes down, comes back up, so lower high as well. That could switch. That might be bad. But for now, we're looking at a bullish outlook. Sideways, it's far too close between S1 and R1, but it is possible. But I'd like to see RSI at 50. I'd like to see the Bollinger Bands narrow like the dollar against the JPY. So if you see these Bollinger Bands in gold, then yes, we could see a sideways bias. If it breaks below S1, I'd switch for a bearish outlook. Why? You would break this higher low. You would break the trend line. You would break below the mid range of the Bollinger Bands and could imply a shift. But from the fundamentals and from a technical point of view, I would maintain a bullish outlook for the precious metal, at least for today. If something else happens that we haven't predicted or factored in, then there's nothing really that we could do. And this is not 25K, this is 2,500. Apologies. Yeah. For now, what we're seeing, technicals and a fundamental, could be bullish for the precious metal. Same goes for oil. You have geopolitical tensions also aiding oil. It's not just the API implying a greater drawdown than expected or China's economic recovery. You have rising geopolitical tensions. If you have an increased, I want to say increased conflict, if you have increased tensions between two, I'd say, military nations in the Middle East who could go tit for tat in terms of responses, oil prices could move higher. Iran is an oil exporter as well. And if you have a military response, then the tension in the Red Sea, so the risk that are posed from Yemenis Houthi rebels, could remain elevated or could even increase because nobody knows exactly how they're going to reply. They could use one of their proxies, it could be direct, it could be indirect, but overall it's bad for oil because you have the region, the Middle East, supplying oil into Europe. And then if tensions are higher, that means insurance premiums for ships are higher. And they already have to go around the Horn of Africa instead through the Suez because you have the risks of your ship being shot by a missile. That's bad. Oil prices move higher. Costs of production are higher. And that gets passed on to the consumer. And you can see higher oil prices. From a technical point of view, that could also be supported. RSI at 70, Bollinger Bands, upwards moving trend line. But even if it does break this upwards moving trend line, I'd still be bullish as long as it doesn't come back down to S1. So it just breaks below. So taking people that potentially went long here, let's just show that. If it comes back down here, I wouldn't switch for a bearish outlook. I would require it to break below S1 for me to switch to a bearish outlook. If it comes back down to 83.34, for example, and then retraces higher to 84.50, but doesn't break above 85.40, then you could maintain a sideways bias. But then for today, you have the EIA report, and then you have OPEC Plus meeting, which I don't think would allow it to stay in a sideways fashion. According to Reuters, their sources are saying that nothing is going to change. Now, we're expecting, or at least I'm personally expecting nothing to change. You have oil prices higher, so there's no reason for OPEC Plus to reduce oil supply even further. So I personally don't think they're going to change anything. But even the statement could provide some support for oil prices. But I think it's more of a geopolitical risk and the API plus EIA, but predominantly geopolitics. Now, if the EIA, however, post a surprise increase in inventories, then yes, that could weigh on oil, drop down, and we could switch for a bearish outlook if it breaks below down S1. If it does not, sideways bias. But for now, it looks to be on the up and up. You might see a relative stabilization leading up to the release of the EIA weekly crude oil inventories before market participants decide on crude oil's direction. Our favorite company, Boeing, appears to have recovered slightly, keeping my R1 level and S1. If there's anything else you'd like to see, feel free to ask in the chat. For now, you have R1, S1. They're staying the same. I mean, it's Boeing. Now, we do maintain a bearish outlook overall for the company. as there is a possibility that criminal charges may be brought against the company, which could weigh on the company's stock price. But from a more macro perspective, let's say quarter 3 or quarter 4 2024, we might see a recovery by Boeing because despite the issues faced by the company, it provides competition to the market. And then you have United Airlines, for example, which is predominantly Boeing. So their fleet is based off Boeing. You have supply chain logistics, you have pilots which are trained on Boeing airplanes. Then you have the parts, the maintenance, the engineers, and changing all of that to move to Airbus could be far too costly, which is why we're seeing some support in terms of public statements for Boeing that they have to fix their issues and that they don't want them to go bankrupt essentially. So, from a more macro perspective, we could be bullish on Boeing if it drops down to a particular level. For now, we could maintain our bearish outlook, although we're seeing a crossover. That's still bearish. Bollinger Band is still to the downside. RSI 42 on the daily chart. I'm still waiting to see the final impact on the company stock price before I decide on a particular direction or if it's time to go long on Boeing. Airbus correction. If it gaps down below, this could be an island reversal, so it could be short for the company stock price. I actually like that it actually hit our R3, 171.35. That's nice. But if you look at the RSI, it's at 40. So it's bearish tendencies for the company stock price. On the daily, the bulls appear to be losing momentum. 4 hour temporarily would maintain a bearish outlook for the company stock price down to 163.30 potentially. Nvidia, double top. Bulls appear to be finding it difficult to move the stock price higher. It's actually broken below the mid-range of the Bollinger Bands, RSI dropping to 50. I would no longer be bullish for Nvidia. I'd maintain a sideways bias for the company's stock price as long as it stays above S1. If it does not, bearish. But look, it's finding trouble to break above R1. RSI is dropping below, appears to be smoothing it out, so I wouldn't be bullish. I'd maintain a neutral bias between S1 and R1. Looking at Apple, 38, so bearish tendencies, S1 and R1 continue to be validated. Wouldn't be bullish on the company stock price. We've done Tesla. If I'm not mistaken, we do offer TSMC as well. Let's just look. Now, the reason why I want to look at TSMC is because, if I'm not mistaken, they have evacuated some of their production lines. Let's see. TSMC. Which could weigh on the company's stock price due to potentially the risk of a reduced output. We're also entering season earnings season once again, starting with JP Morgan and Citigroup next Friday, so that might be interesting. And we will definitely look at it next week as well, as that nears. I've read it. Index. Okay. See TSMC. Can't seem to find it now. Nonetheless, we could look at what could we look at that might be interesting. Cocoa. We could look at Cocoa. IBM, Intel. I actually like to look at Intel. Templates. But we already have. Well, let's look at Intel. Now, if TSMC is finding it difficult they're not finding it difficult. It's only temporary. The reduction in the production lines is just due to the potential risk of a tsunami. So even if it does dip, it might come back up. But let's look at Intel. Support 4350, 53.50. That's this one. So price action closed and open at this particular level, so appears to be validated. Look at the prior historical data as well. Seemingly, this level appears to have support. Now, for S2, I'd like to take the beginning of this gap that occurred, so 42.10. Now, with stocks, since we don't really look at them on the daily, I'd like to give them more space. So, if we're looking at the euro or the British pound, so cable, we might put closer support and resistance levels are a bit more intermediate and not from a more macro perspective because we look at them on a daily basis. But with Intel, where we look at it perhaps once every 2-3 weeks, I'd rather play something that's much more long term so that in the event that someone does look at our support and resistance levels, they'll be valid when we look at them back again. So, same, let's look. So, look at Google. We have placed resistance in March. Coca-Cola, Airbnb broke above, found support, broke down below, resistance turned to support, turned back to resistance, actually broke down below our old support level. So this is bearish for the company stock price, taking aim for 155. So overall, placing a bit bigger of a distance just in case we don't look at it uh, in the tomorrow or in the next week, so that it's valid further down the line. Resistance at 44.58 this week, I'd say, is an anomaly. It took out everybody that had a stop loss here. And then we have taken profits. Look, it opened and closed here. So resistance, so sellers coming in. Sideways bias between S1 and R1 due to the RSI 53. And if I add the Bollinger Bands, I think they will most likely show the same picture as well. Bollinger Bands. Yep, narrowing of the Bollinger Bands. Sideways bias for Intel. So you have S1, S2, S3. And then for resistance, we can take 46.45. That could be Intel. And then let's look at R3. I should explain 1 and then 2. Double top. Look, it came back up. Came higher. Failed to break below. Gapped lower. Came back up for a second try. Failed. Moved lower. So resistance, in my opinion. And then for R3, something that's not too close but not too far. Too far away. Let's see. 48.77. So looking at these two candles here, nicely. Now, it's not too close to R2, so that's a plus. But is it valid? That's too far away. Slightly too close. But based on what we have, I don't think we really have another option unless no. I place R3 at 47.75, but a bit skeptical of that level. Now, when placing support and resistance, I like to look at the price action. If there's something recent that you can use, that you've seen that it's either fluctuating around, or if it moved lower, so broke below and then moved lower, closed on it, or closed above it, etc., that I'd like as a support and resistance level, which is why I was playing around, trying to see if it coincides with something that's recent, which is also why I looked here as well. But here, that's only the last two. Doesn't even take this into account. It's a bit might be an actual resistance level, but until we see the price action coming back up to test that, I'd rather take something that appears to be slightly more tested. So here, failed to break below, moved higher. Prior history, broke below, moved lower, came back up, moved lower, broke above, moved slightly higher, but when it came back below, it moved lower. So this appears to be a more of a valid resistance level, but you never know. It depends, and we'll have to look at it at a future point in time when and if the stock price moves higher. Is there anything else you would like to see, or I think that is it for today? I'll give you a minute. Anyone wants to see something in particular? Now is the time to ask, or else we'll talk tomorrow, in which we'll go on a detailed analysis of Fetcher Powell's comments later on today. We'll look at the impacts of the EIA weekly crude oil inventories report. And since it's a Thursday, we'll prep for NFP Friday as well. So we'll see what the expectations are, the possibilities, the scenarios, potential movements before, how they may react. We'll also look at the Fed speakers later on today and how that it's impacting. We'll look at gold since it's moving higher and forming all-time highs. We'll look at oil as well, given the geopolitical risks. The Aussie, we could perhaps we'll look at it as well, but we'd place more emphasis on the euro, JPY. I'd like to see the impacts and the potential market reaction should there be a tsunami, because at the current point in time, it's only a risk. But if it does occur, we'll see the impact. Now, note that it's nearing levels upon which we may see government intervention. So, even if it does break above R1, the question is for how long and how far high will it reach? But since I'm not seeing anybody, excuse me, that wants to see something in particular, I believe that we've covered most of it. Have a wonderful day, morning, evening, and I'll see you all tomorrow, same time, same place. Thank you for watching.
Okay, so as per usual, before we get started, just a risk warning. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer: the information in this webinar should not be construed as investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. And today we're going to be talking about IC trading. IC trading, yeah. So this is a trading strategy that is pretty unique. So here's our agenda for today. We'll talk about what exactly it is and then get into some of the key concepts, followed by understanding what exactly it is and how you can make use of it. And then we'll look at what smart money looks like in price action. So if you guys have any questions throughout the webinar, feel free to pop a question into the chat and I will be happy to answer them. Okay, let's go ahead and get started. So what is ICT? So basically ICT stands for inner circle trading. Okay, let me just allow you to pop your questions into the chat. Okay, so let's start by defining what exactly we mean by inner circle trading. So ICT, or inner circle trading, is a trading methodology that focuses on understanding the inner workings of the financial markets. So it involves analyzing market dynamics, identifying supply and demand zones, and utilizing price action analysis to make informed trading decisions. So it has now grown to become one of the most popular trading strategies around, focusing instead solely on price action. And it was originally created by Michael Huddleston to trade the forex market, but currently traders are using the same strategies to make profit in all and any market that they trade. So, yeah. So why exactly is it important for us to understand what ICT is? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give you a significant edge as traders. So by mastering the ICT techniques, you can enhance your ability to identify high probability trading opportunities and effectively manage your risk. So what exactly it is basically employing chart technical analysis and operates under the premise that by studying price movements, support and resistance levels, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration and consequently forecast emerging trends. Okay, so let's get into some of the key concepts. Okay, so firstly, for our key concepts, we'll go through liquidity, followed by displacement, market structure shift, inducement, fair value gap, optimal trade entry, and lastly, balance price range or order block. So these are the fundamentals that you need to know in order to take advantage of trading in this style. So firstly, first key concept we'll go through is liquidity. So there are basically two types of liquidity. There's the buy side and sell side. So firstly, buy side liquidity represents a level on the chart where short sellers will have their stops positioned. So sell side liquidity is just the opposite of that. So it represents a level on the chart where long biased traders will place their stops. In both cases, these levels are found at or near extremes, as the tops and bottoms of ranges are often viewed where traders are proven wrong and therefore will want to get out of their trades. So here's an example. So smart money players understand the nature of this concept and commonly will accumulate or distribute positions near levels where many stops reside. So you can see here, our sell side is on the bottom where the swing lows are. Buy side is where the swing highs are. So basically, it's where your resistance and your support levels are. So it is in part the sheer amount of stops at key levels, like those that I've just identified on this chart, that allow a larger player to fully realize their position. So once the level at which mini stops are placed has been traded through, it's often that the price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. Okay, so you can see normally at these resistance levels, you would expect price to reverse off of these levels. Similarly, for your support levels, you would expect price to bounce off of those levels as well. So that's just basically what we are trying to say over here. Okay, next, let's look at displacement. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have large real bodies, so you can see in the image here, your strong selling pressure would look like these candlesticks here, which have large real bodies, very short wicks, like you can see here, and that kind of suggests that there is very little disagreement between buyers and sellers. And if we are looking at strong buying pressure, like the one we see over here, similarly, you see that the body of a candlestick is long, whereas the candle wicks are pretty short. So a displacement will normally occur just after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. So we'll get into what those mean in a little bit. But basically what it means when we say a displacement occurs after a liquidity level has been breached is if you look at this area here, this is a multiple swing low support level. You can see price has recently broke out of that level. If you can imagine this horizontal line just over here. So it's broken out of it and is reversing off it now. And that is what is resulting in a strong buying pressure. So that's just basically what it means by a liquidity level has been breached. So if you think about it as what we've been going through normally, which is through your support and resistance levels, it's pretty easy to catch. But let me know if you guys have any questions so far. Okay, if not, let's move on to the next key concept, which is a market structure shift. So there are two major market structure shifts. It's just another way of saying it's a trend. So we have an uptrend, which is when the price is making higher highs and higher lows, and a downtrend in which the price is making lower highs and lower lows. So it's pretty straightforward, but if we are referring to something that we talked about previously, um, you can see in this example, we have swing lows. Yeah. So these sessions are recorded. I think they will be uploaded onto YouTube, but I'm not too sure. You can email IronFX. I think the email is on their website. So let me just check. But yeah, you should, if you email them, I think they will be able to send you the recording or at least give you the link to the right place. Let me see if I can find the email. Okay, I think if you go onto the ironfx.com website, you can just email them over here, support@ironfx.com. And I think they'll probably send you the link to this recording. Okay. Sure, no worries. Okay, so where were we? Yeah, so when you're looking at market structure shift, it's important to find a market structure that has very clear movements in price. So if you look at the GIF that I've included here, there's a very clear price movement with swing highs and lows that are really significant. Okay, another example would be of a clear market structure. This isn't. Oh, let me go back to my slides. Okay, so this is the GIF that I was talking about earlier. So you can see that there are very clear movements in price with clear swing highs and very clear swing lows as well. If we look at this market structure, it's not as clear, but you can see that it's a very clear downtrend. So that's just basically what we're looking for over here. Okay, but typically we recommend you to look for a market structure that's clearer, something like this. Yeah, or something like this as well. So it doesn't have to follow a trend line. So over here you see that we have four um four swing highs that line up on this trend line. And it doesn't have to line up on a trend line. I'm just using this picture to show you what you can look out for. So here you see that we have higher lows, or rather lower highs, since it's a downtrend. Okay. So next key concept we're looking at is the inducement. So rarely does the price move in a straight line. So within a larger trend, there are almost always counter-trend moves. These counter-trend moves are the results of lower time frame liquidity hunting. So let me show you an example. So if you see in this example where we have identified the market structure shift, it's basically when price has broken below this swing low. Okay, so that's a market structure shift. The inducement is when price has bounced off, which is over here, bounced off and is reversing off of a new resistance level. Okay, so the price will bounce or get rejected and then will target a previous short-term high or low before continuing in the same direction as the longer-term trend. So the short-term high in this case is here, all of the circles over here. Okay, and then it continues in the same direction. In this case, it's a downtrend in the longer term. So, yeah. So inducement is specifically targeting these short-term highs, like those that we've circled, or short-term highs or lows as areas where these stops might be placed. So because you're expecting price to reverse off of these circles, you might decide to place your stop loss right above these levels here. Okay. Okay, now next key concept we're looking at is the fair value gaps. So these are created within the displacement and are defined as instances in which there are inefficiencies or imbalances in the market. So if we visualize what this means, it's basically a three-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. So let me show you an example of this now. Okay, so if we look at the fair value gaps that have been filled, okay, you can see that these, if you follow the arrows, right? The fair value gaps are basically the levels in which price has retraced and is testing that level again. So it's basically what we previously mentioned as um, overlap resistance or support levels. Or in this case, it's support overlap areas. Okay, so you see price reversing, testing that level, bouncing off of it. Similarly, price reverses, tested that level, and reversed off of it. And same thing over here. So in the example that I have here, the fair value gaps that are unfilled are basically the levels that don't reach that same level or the same areas from the previous price. Okay, I hope that makes sense, but you can just look at the chart, the example that I have here. Okay, so maybe to start off, you can look for what we've mentioned in the previous slide, which is the three candle sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. So you can look for some of those examples in over here. Okay, so next let's look at optimal trade entry. So the optimal trade entry represents the best places to get into a trade, and they can be identified by utilizing the Fibonacci between 61.8 and 78.6. So maybe I'll show you an example. Our previous webinars recently were on Fibonacci, but if you missed that, I'll just briefly go through it here. Let me just pull out my let me just show you guys a website. Okay, so if you missed our Fibonacci series, not to worry because we'll probably go through that again. But because we recently finished that, so it might be a while. But anyway, so the website that we recommend you to go through is theforexarmy.com, and it goes through how exactly to draw a Fibonacci retracement correctly. So there are some videos that you can take note of, the market structure to keep an eye out for. Okay, so if you're looking at using the ICT to find an optimal trade entry, they recommend to use a Fibonacci between 61.8 and 78.6. So although we typically use these levels, you would just be looking at these two levels here. And how that works is basically by looking at the highest starting point to the lowest, okay, or like something here. Shows you the invalid as well. Yeah, but you can just go ahead to this website and take a look. Okay, I think I'll just pop it into the chat. Oh, we have a question. Okay, what happens to FVG that has not been filled? So if we go back to my slides, basically what it means when it's not filled is that we don't expect price to return back to that area anytime soon. So we are not going to use those levels as we're not going to take note of those levels. We want to take note of these FVGs that have been filled in order to place your stop losses and your take profit levels, yeah, according to those levels. Okay. I'll show you guys on TradingView, there is an indicator that helps you to find FVGs. So it's probably the easiest way to spot those, but I'll show you in a little bit. Okay. Yeah, I was talking about optimal trade entry. So the link that I've popped into the chat basically goes through the fundamentals of how to draw a Fibonacci, which I'll briefly go through here as well. So this is a Fibonacci retracement checklist. So firstly, you want to see is the market structure clear? So we showed you previously how to identify a clear market structure. Next, we want to look for the recent trend, so are prices going up or down, and it's important to always follow the general trend. Next, we want to identify recent major swing lows and swing highs, like those that we've identified previously, and then connect the two extreme points like we have done over here. So since this is a downtrend, your starting point is at the swing high and your ending point is at the lowest swing low. Okay, here you can see all the different Fibonacci numbers that we mentioned in the previous slide. So for the ICT, we are focusing on 61.8 and 78.6. Okay, but it's basically the same thing. Here's another example. So we are looking at the level at which price bounces off either your 61.8 level or your 78.6 level. Okay, now let me get back to my... Okay, so after optimal trade entry, the next key concept is a balanced price range or imbalance. And this is the result of an aggressive move up that's immediately followed by an aggressive move down, or an aggressive move down that's immediately followed by an aggressive move up. For an uptrend, do we start the Fib 0 at the bottom or the top? Okay, I'll show you in a bit. Do I have it here? Yeah, so like something like over here, we would draw it, your starting point here, and then your ending point would be here. So your 0% would be at the top. Okay, yeah, balanced price range. So what's left after either of these instances is essentially a double FVG or fair value gap, which can act as a magnet to the price before a continuation move higher or lower. So balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from those areas. Okay, so now let's look at what smart money looks like in price action. So SMC trading involves looking at order blocks, which is a refined version of supply and demand of an asset, and then your breaker block or mitigation blocks. This is what is traditionally called your support and resistance. Flip zones, and then your FVGs, which are imbalances on the market. So when demand outpaces supply or vice versa. And then lastly, your liquidity gaps, which we went through before, are basically the areas in which there is a support level or a resistance level. Okay, now let me pull out my charts. Okay, so if we are looking at DXY, just a random chart, how you basically implement the FVG indicator, okay, is okay, you go to the indicators, search for fair value gap, and this one. Okay, so this helps you to identify any of the FVGs. Okay, and you can use this on any time frame as well. So I'm on the 1 hour time frame now. Okay. Yeah. So the one that we use is the Luxel Gold one. This one here. This one. Lux Algo. So this automatically helps you to find FVG on any time frame, and it will help you to highlight the level as well. Okay. Okay, so you can actually use um these key concepts more as like a checklist when you're using the ICT trading strategy. So firstly, you look for the liquidity, followed by the displacement, look for any market structure shifts, inducements, value gaps, and then use your Fibonacci levels to find your optimal trade entry, followed by the balanced price range, which is basically looking for a double fair value gap over here. Okay, let's look at this example maybe. Okay, if I can find a double fair value gap, I'll show you as an example. But one of the websites we used, okay, let me just share that website with you. Because this is quite a niche trading strategy. So I'm just gonna share all the resources that we use. Um, so basically what I mean by a double fair value gap. So you can look at this website as well. Um, but basically this is what we are looking at. Okay, so we have a balanced price range up here, which is essentially where price rebounds off of a resistance level. It drops and then it tests that level again. Here it says price testing and rejecting your VPR. Basically, if you were here for our support and resistance levels, we just we're just talking about a double swing high here. So it's just basically where the level is reversing off of that same level before, the same resistance level as before. Okay, and the reason why we are highlighting this entire area is because that's basically where we see price being attracted to. So it tends to be attracted to such areas and then reverses off of it. Okay, let me go back here. Okay, if we go back to the, yeah, to my chart here, so you can see that our fair value gap is in this area here. Okay, we have this green highlighted area, which is in line with this swing high. If we look at this fair value gap highlighted here, this is in line with this resistance area here as well. Okay, so we're expecting price to continue to rebound off of this area, yeah, and drop below it. So that's for resistance levels. We're looking at support levels. Here we have a swing, a, a couple of swing lows that match up with swing highs. Okay, so this is one swing low, two swing lows, and then a swing high, right? So this is a pretty significant level, and using your fair value gap basically helps you to highlight any of such areas. So like I mentioned earlier, these are not really specific levels, they're more so areas. Okay, and if we use, let's see if we can make use of our Fibonacci levels as well. Okay, here we see that we have a nice 38.2 that lines up nicely with this area. Okay, if I look at our 61.8 as well as the 78.6, okay, you can see that that also lines up with the highlighted fair value gaps over here, okay, as well as the 78.6 doesn't really, apart from this swing low, it doesn't really match up, which is fine. It doesn't always have to match up. So you can see that this 61.8 is a pretty significant level here. Okay, the reason why I say it's significant is because we have one swing low, two, 3, and 4 levels that are lining up. So we can expect price to be attracted to that area again and then bounce off of it. Okay. Yeah, I think that's all the time that we have for today. Again, so sorry for the delay because of the time mix up. But yeah, let me know if you have any other questions. Um, yeah, for with regards to the recording, the email is on the IronFX website, and you can probably get the recording from them. And next week we will be going through the second part of this ICT series. So yeah, stay tuned for that. Yep, I think next week we will start the usual time. So there won't be any scheduling mix up again. Yeah, but so sorry about that. Thanks everyone. See you guys next week. Bye.